Why are there so few published research papers that apply deep learning to algorithmic trading? Algorithmic trading, often called algo trading, has revolutionized the financial markets, allowing institutions and individuals to execute trades at lightning speed with precision. In parallel, deep learning, a subset of artificial intelligence, has proven to be a game-changer across numerous domains such as image recognition, natural language processing, and autonomous systems. It seems natural to assume that the intersection of these two cutting-edge technologies would lead to a plethora of research papers. Yet, surprisingly, this isn't the case. Why are there so few published research papers that apply deep learning to algorithmic trading? This video delves into the reasons behind this scarcity, exploring the secretive nature of the financial industry, the challenges unique to this field, and the growing shift toward private research. One major reason for the lack of published research in this area is the secretive nature of algorithmic trading. Algorithmic trading operates in one of the most fiercely competitive environments, the financial markets. Here, even the slightest edge, like predicting stock movements milliseconds faster than competitors, can translate into massive profits. Given these high stakes, firms treat their algorithms as prized possessions. Proprietary trading firms, hedge funds, and investment banks typically guard their methodologies, often going to great lengths to prevent any leakage. Publishing detailed research on deep learning models used in algorithmic trading could inadvertently reveal trade secrets. Such revelations could erode competitive advantages and result in significant financial losses. Consequently, researchers and firms in this domain often choose to keep their findings under wraps rather than sharing them with the academic community. Imagine having a formula that prints money. Would you share it with the world? That's essentially the position many trading firms find themselves in. Intellectual property lies at the heart of their success, and publicizing it would mean leveling the playing field. For instance, firms like Renaissance Technologies or 2 Sigma are known for their extraordinary secrecy regarding their trading strategies, which is why their approaches rarely surface in public research papers. Another barrier lies in the challenges of applying deep learning to algorithmic trading. Financial data is notoriously complex. It's riddled with noise, randomness, and non-linear patterns, making it extremely challenging for even the most sophisticated deep learning models to extract meaningful insights. Unlike images or text data, financial time series data doesn't have clear features or predictable structures. This can lead to overfitting, where a model performs well on historical data but fails to generalize to unseen market conditions. Adding to this is the issue of data limitations and accessibility. Historical market data, especially at the granular level required for algorithmic trading, is often expensive and tightly controlled. Even if researchers manage to obtain such data, it's not always consistent or reliable due to issues like missing values, split adjustments, or inaccurate timestamps. Deep learning in trading also raises regulatory and ethical challenges. Regulators, such as the SEC in the US or ESMA in Europe, enforce strict compliance requirements on trading algorithms to ensure fair and transparent markets. The complexity of deep learning models makes them harder to explain, raising concerns about accountability. Additionally, the automation of financial decision-making can lead to ethical dilemmas, such as exacerbating market volatility or creating unintended biases. The scarcity of research papers can also be attributed to academic and practical barriers. There's a noticeable gap between academia and the financial industry. While academic researchers focus on theoretical advancements, financial institutions prioritize real-world applicability. Furthermore, access to industry-grade datasets is often restricted to employees of financial firms, leaving academics with limited resources to conduct meaningful research. Financial markets are highly dynamic, meaning models that work well in one period may fail in another. This makes reproducibility, a cornerstone of academic research, particularly challenging in this domain. Additionally, there's a lack of standardized benchmarks or datasets in financial AI research, further complicating efforts to validate results. Deep learning models also require significant computational power, which translates into substantial costs. This can deter independent researchers and universities from pursuing large-scale experiments in this field. Moreover, the financial risk associated with testing new trading strategies in live markets further adds to the barriers. Another reason is the rapidly evolving nature of both deep learning and financial markets. Both fields evolve at breakneck speeds. By the time a research paper on a new model is published, it might already be outdated due to advancements in AI or changes in market behavior. This constant flux disincentivizes researchers from pursuing long-term studies in this niche. Algorithmic trading demands models that are not only accurate but also adaptable to real-time market conditions. Many academic researchers lack access to the infrastructure necessary to test their models in live trading environments, limiting their ability to contribute to this field. Additionally, there has been a shift toward private research and patents. In recent years, major firms now operate their own AI research labs, staffed by leading experts who develop cutting-edge algorithms behind closed doors. Publishing research requires time and effort, with little financial incentive for private firms. Instead, companies prioritize patents and trade secrets, ensuring that their innovations remain within their control. This has further reduced the number of publicly available papers on deep learning and trading. Despite these challenges, emerging trends present new opportunities. The rise of open-source tools has democratized access to AI and financial research. Libraries like TensorFlow, PyTorch, and specialized platforms for quantitative finance have enabled independent researchers to experiment and innovate in algorithmic trading. Some organizations have recognized the value of collaboration, leading to successful partnerships between academia and industry. For example, projects like JPMorgan's AI research initiatives or collaborative grants from the NSF have begun to bridge the gap, offering a glimpse of what's possible when knowledge is shared. In conclusion, the scarcity of published research papers on deep learning in algorithmic trading stems from a combination of secrecy, technical challenges, and the prioritization of private research. While the barriers are significant, the potential of deep learning to transform financial markets remains vast. Greater collaboration and transparency could unlock new possibilities in this exciting domain. Thanks for watching.